Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining me. On tonight's show, I'm going to look at the reasons why you should rule out the likelihood of a crash of the stock market. And then Jason Tay, who manages the Switzer Dividend Growth Fund, will be coming along to talk about the income stocks he's chasing right now, and also whether it's time to get worried about the CBA and its enormous share price of $132. Is a rotation going to come, and will these great stocks that I think are overpriced, will they start to fall over time? And if so, where do you go looking for income or stocks that grow at a strong pace like the CBA has, surprisingly, in recent times? So let me kick off with a story which I wrote for Switzer Daily, and I've now done it for the Switzer Report as well. And it came to me because one of my financial planning clients had watched a report on the ABC where the commentator was saying that US stocks look stretched in their value and that a significant market sell-off was likely. And my client quite legitimately asked what I thought. And I said, I'd write you a piece to explain why I think stocks can keep on going up, at least over the next 12 months. Many of my financial planning clients, I will be having a talk to them this time next year after I expect a good rise in the market, and we might become more defensive. But I do think for the next year, it's very likely that stocks will do well, despite the fact there could be a couple of months, August, September, little bits of October can be negative, but after that, I think this market will roar up to another level. And here are the reasons why I'm not particularly worried about Australian stocks in particular. Our market is only up something like 15% in 2 years. Against that, you've got the US market up a lot more than that. I think the Nasdaq up about 60%. The S&P 500, that's the US top 500 stocks, up about 49%. So we've really lagged behind. And part of the reason is that we're not high tech in our companies in the ASX 200 index, like the S&P 500. We don't have those magnificent 7 stocks, the famous ones like Amazon, Apple, Microsoft, Tesla, and NVIDIA, of course, that's the big one nowadays, NVIDIA. Now, all of these have really pumped up the S&P 500. And when you pull them out, the S&P 500 is not up all that much more than our market. And so my argument is that when interest rates start to fall, lots of other companies that have been ignored in the US market and ignored here in the Australian market will start becoming very, very popular. And so I see the argument being this. US interest rates are likely to be cut for the first time since the 11 interest rate rises after the pandemic in September. So the market will undoubtedly like that, and there'll be more interest rate cuts because the Federal Reserve, which is the central bank, of course, never just cuts once, it cuts twice or 3 times. The market will like it. Now, eventually, the market will say, we expected a lot of this, so the gains aren't going to be all that great. But what will happen is companies that were really dumped when interest rates rose, these ones will become really popular. There'll be a rotation out of the companies have done really well, and the money will flow into stocks that haven't been doing well. And I think that's going to be the big driver of the market in the next leg up. And so, I started looking around for reasons to believe that I'm right. And I found that historically, with US elections, over the course of that year, the market goes up, necessarily by the greatest amount, but it does go up. There's a 93% chance, according to the money market, that interest rates will be cut in September. That's going to be good for the stock market. The chief investment strategist, John Stoltzfus at the US investment bank Oppenheimer, he's raised his year-end S&P 500 target to 5,900, where he was at 5,500 before that. And at the moment, the index is at 5,600. So there's still plenty of potential rise in the S&P 500. Also, the history shows that when a US market hits an all-time high, there's usually a long run of all-time highs before the market sells off. So I'm in the middle, I think, of an all-time high rising section for the market, and I think because I know interest rates are going to be coming down in the US, that's going to be a really great stimulus for the US economy. Shane Oliver from AMP, his arguments are that the US market goes higher on the cuts in interest rates, but he also thinks that the Australian market, he's got a target of 8,100 for our market. It was 7,900 before. He's raising his expectations about Aussie stocks. There's a guy in America called Professor Jeremy Siegel from the University of Pennsylvania, arguably the best academic caller of the US market. He's making the case, basically as I inferred, that the one big tech sector has done really, really well, but there are 10 other sectors in the US stock market likely to do really well as interest rates come down. So that's another tick for the optimists like me. Also, usbank.com looked at the S&P 500 outlook and made the very strong case that the outlook is actually strong based on earnings. And earnings are really important to share prices. Also, lots of analysts in America are saying even if the bigger cap companies come off the boil, it looks like these cuts in interest rates are going to be good for small caps. And last week, the Russell 2000 index, which captures a lot of the US small cap companies, up about 5 or 6% for the week. And also emerging economies do really well as US interest rates come down. And the US dollar falls and the Aussie dollar goes up and other currencies gain as well. Also, Reuters recently put this report out. Stocks have typically risen in the 6 to 12 months period following the first Fed rate cut, as long as there's no expectation of a recession. And at the moment, there is no real talk of recession in the US. So if we get the first cut in September, then if you look at history and say, well, for the 6 to 12 months, there's a good chance that the market will go up. That's another strong reinforcement effect for my overall positive view for stocks. And of course, Investopedia, just looking at the history of stock markets and interest rates, made it pretty simple and just said when interest rates fall, stock markets go up, and that's the history and the relationship between those two factors. So putting it all together, I think my financial planning client should have faith in the fact that the next 12 months it's good to be exposed to growth assets, but maybe in 12 months' time we might become a little bit cautious, but I don't want to be cautious right now. And that's my take on where I think the market's going. If you want to see the next interview with Jason Tay on income stocks and what he's doing with a stock like CBA as it hits $132, well, you're going to have to be a subscriber to the Switzer Report. I hope you can do that. Thanks for joining us. See you next week.